What's the advantage of tax loss harvesting?
Oh, tax loss harvesting. Scintillating subject. So, no, but it's actually really important. What we do here, generally speaking, and this would be in an account where when you make a transaction, it ends up on your tax return, right? So an IRA, that doesn't happen. You don't have to put on a tax return. The only thing I put on your tax return from an IRA is if you take money out, right? And it goes on your tax return. You can buy and sell inside of an IRA, a 401k, a 403b, a 457 plan, all these retirement plans without it being on there on your tax return. So what we're talking about here is a taxable account, right? People call them individual accounts. Sometimes they call it a trust account because they have it in a trust. Their brokerage account. Everybody's got different names for it, but in the end, whatever dividends, interest, and capital gains or losses end up on your tax return. So capital losses are useful. I'd rather that everything we bought went up every day and we never had a capital loss. But, things do vacillate. So right now, for example, is a pretty good time to harvest losses. We did some of it yesterday when the market fell. And really, so at the beginning of the year, if I have some gains in positions that I'm not that excited about keeping, I'll generally take it right at the beginning of the year. And then I try to find capital losses throughout the rest of the year to essentially offset those gains. And so that's what they call harvesting. So I might have a position that I really want to keep, I don't have any problem with it, but it's at a loss. I'll sell it, and I'll either buy something else, or I will put it in the money market. 31 days later, I can buy it back if I want. So that's one of the tax loss harvesting pieces. And so there's a little bit of a gray area as to what else you can buy. You have to be careful. You cannot buy back the same stock. That's fairly obvious. You sell Ford, you can't buy back Ford the next day. You have to buy back Ford 31 days later. That's just the way it works. You can buy GM. That's not a problem. But if you sell an auto ETF and buy a different auto ETF, that's the gray area right now as to what you can do there. I've not heard of anybody being really called to the carpet on this, and having their loss disavowed because of that. But nonetheless, it's something to be a little careful of. Obviously, the best option is to just, buy something completely different. And so that's what we'll do. We kind of change the models, and those things that are at a loss get swept out. We buy new things. So we're still basically in the same spot in terms of risk, and then we gather those losses. So if I took 100,000 in gains in January, then I'm going to try to find 100,000 losses in a market like this where things are down. And so because it's money in the bank, if I can find $100,000 worth of losses to offset my $100,000 worth of gains, it saves me roughly $25,000-$30,000 in tax that I would have had to pay. I can get that back maybe to zero if I can find the losses to do that. And so what it does is because theoretically those could all come back and be profitable, right? But I bought, I sold them at this point at the bottom, bought something fairly similar, still comes back, and I gathered that loss right there. And then I can use that against my gains. Even if I don't have gains, I can carry forward losses for years and years. You can write $3,000 worth of your losses off of your ordinary income every year. And then any other gains that you get, I think it's 15 years in total, you can continue. So it's like money in the bank. It just wipes out these gains that you can take, on your holdings. So tax loss harvesting is really, an important component, that's for sure. Yeah.